Welcome back to another trade video. If you're new to the channel, I usually do weekly videos going over my trades for the week and talk about what trades I'm taking for the following week. This video is part of a new series where I talk about the option strategies that I use. And in this video, I'll be going over how to trade cash secured puts in Thinkorswim. And before we get to that, don't forget to like and subscribe so you can stay up to date on all of my trades. And just as a caveat, in this video, I assume you have some general knowledge about what call and put options are and know about buying and selling options. If you don't, I highly recommend checking out some videos online before watching this, and I'll probably release a video in the future talking about the basics of options as well. So now kind of jumping into what is a cash secured put. So at a high level, a cash secured put is basically selling a put option and then having enough money to purchase the stock in case your put option gets assigned. And I'll walk through a live example of what that looks like. As you can see here, we have Apple pulled up. And for this example, I'm going to sell a put option right here at around the 126 level because it seems like Apple keeps kind of bouncing off of this price point. So once I have that strike price established, the 126, I can then go over to the trade tab. And on the trade tab, you can see a bunch of different expiration dates. I'm going to go ahead and do one that's 8 days out because I usually like to do weekly ones. And then I'm going to go down to the 126 strike price on the put side. And here you can see the bid is 1.57. So that's how much you could sell this option for. So if I click that, and then I'm going to go ahead and set the quantity to one contract because I only want to sell one contract. I'm going to set the price to 1.57, and then if I hit confirm and send, the trade will go through. I am kind of showing this on a simulated paper money account right now, so it won't actually go through for me, but it will show that the order is working. But some of the key things that I wanted to call out here is the 1.57 bid price is the selling price. So that means as soon as I sell this option contract, I would get $157 into my account. And now kind of jumping back to the actual chart, I can show what would happen if we did sell that strike price for that amount. So let me go ahead and add in a line right here for the 126 strike price. So right now I'm selling a put option at the 126 strike price for a max profit of $157. And the reason it's $157 instead of $1.50 is because every option contract is equal to 100 shares. So as part of the example, I'm selling the 126 strike price for 8 days out for a max profit of $157. Now, if Apple just stays above the 126 strike price, I get to keep the full $157 and nothing happens. Now, in another scenario, if Apple ends up closing below $126 at expiration, I will most likely get assigned 100 shares of Apple. And the reason for this is because the price goes below and that option contract ends up getting filled. It's 100 shares because, again, every option contract is equal to 100 shares. And I would be forced to buy 100 shares at $126 per share, regardless of where the actual stock price goes. So even if the stock drops to $100, I would be forced to buy it at $126 per share. And now kind of jumping into some tips and things to remember when selling put options. One thing to remember is that as you sell closer to the current stock price, you would receive more premium. So for example here, if I was to sell the $131 strike price, I would be able to make $350, whereas if I sell the 126, I can only make $157. Another way to make higher premiums is when you add more time to the expiration. So as you can see here, if I sell the 126 strike price, for 8 days out, I can make $157. But if I was to sell the same strike price for 365 days out, I would be able to make $1,615. And the reason for this is because there's more uncertainty when you add in more time. The price can kind of fluctuate as it wants, and there is possibly a higher chance that the stock either goes up or down, and therefore you're being incentivized with more premium for taking on that additional uncertainty risk. And the next thing to note when selling puts is that you don't have to wait till expiration in order to close your contract, or you don't have to wait until your contract goes all the way to expiration. You can close it out early. So for example, if I'm selling the 126 for $157 max profit, and the price just kind of stays around this level, every day I'll make a little bit of money in terms of what this actual option contract is worth, and I could buy it back for a lower value. So I would have $157 in my account, but then I could buy back the option contract for $100, and I would be net $50 in that case. The next thing to remember is that when doing cash secured puts, you need to have enough money in your account to purchase the stock in case you do get assigned. So in this case, in order to calculate how much I would need, I'm selling at the $126 strike price, and I'm selling one contract. So if I do 126 times 100, that's $12,600. So if I have $12,600 in my account, I would be able to purchase the stock, assuming I did get assigned. If you don't have enough money, it's no longer a cash secured put, it becomes a naked put, and you can risk getting margin called. And that's how you sell a cash secured put using Thinkorswim. I will be releasing another video in the future kind of talking about my top 5 tips for selling cash secured puts and what I look for when selling these puts in order to increase your chances of making it a successful trade. So make sure to like and subscribe so you can be notified when that video comes out. And if you have any questions or comments, feel free to leave those down below, and I'll see you all in the next video.